Okay, so we're diving straight into Coca-Cola's Q2 2026 earnings today. And I mean, the top line numbers are just massive. We're looking at net revenues hitting $13.4 billion for the quarter.
Yeah, which is a 7% increase right there.
Exactly, 7%. And if you strip out the noise of, currency exchange rates or recent divestitures, their organic revenue still grew by a really solid 6%.
Right.
Plus, we have earnings per share shooting up 16% to $1.03.
Yeah. And even comparable EPS grew 11%, hitting 97 cents. But honestly, the metric that really jumps out from these documents is the 5% growth in global unit case volume.
Yeah, let's actually talk about that because our mission for you today is to kind of strip away the corporate jargon in this news release and this really dense margin analysis presentation they put out. We want to figure out how a 138-year-old, $13 billion brand actually engineers that kind of growth in such a volatile 2026 consumer landscape.
It's definitely a masterclass in managing global scale. Because, anyone trying to evaluate a consumer goods company knows that unit case volume is basically the holy grail metric.
Right, it's the physical proof of demand.
Exactly. It measures the actual physical amount of finished beverages. They measure it in 192-ounce increments, by the way, that bottlers are selling to retailers. So it shows that real people are out there buying the product.
But wait, I have to challenge that premise right out of the gate here. Because over the last few years, we've seen so many companies boast about incredible revenue growth. But when you look under the hood, it's just an inflation mirage.
Oh, for sure. They just hike prices.
Right. People aren't actually drinking more soda. They're just paying more for the exact same can. So how much of this revenue growth is real physical demand versus just, jacking up the price?
Well, the breakdown in the report answers that pretty clearly, actually. And it proves the demand is real. When you look at the composition of that 6% organic revenue growth, it was driven by a 4% increase in concentrate sales. And then that was combined with a 2% growth in what they call price mix. So while pricing strategies definitely help squeeze out that extra 2%, that 4% jump in concentrate sales is tangible proof. Consumers in places like India, China, the US, and Brazil are physically drinking more of the product.
Just to clarify for everyone listening, price mix is basically the combination of pure price hikes and consumers maybe opting for more premium packaging, right?
Yep, exactly. It's the revenue change from pricing actions, the specific mix of products sold, and the channels they're sold through.
Okay, got it. But I want to pause on a slight discrepancy in the math you just mentioned.
Sure.
You said concentrate sales grew by 4%. But a second ago, we established that global unit case volume grew by 5%.
Right.
So if unit case volume measures the finished drinks sold and concentrate is the syrup used to make those drinks, why is there a 1-point gap? I mean, are they watering down the recipe to stretch the syrup further?
No, the formula hasn't changed at all. It's actually just a fascinating quirk of a massive global supply chain. The report explicitly says that concentrate sales lag unit case volume by 1 point purely due to the timing of shipments.
Meaning what exactly, like logistically speaking?
Well, think about how it works. Coca-Cola sells concentrate to independent bottlers globally, who then mix it, package it, and sell it to a grocery store. In a network that big, the day a bottler buys a massive shipment of syrup doesn't always fall neatly into the same financial quarter as the day the consumer buys the finished bottle.
Ah, okay. So it's just a temporary accounting lag between wholesale and retail.
Precisely. The physical bottles leaving the bottlers grew by 5%, and that remains the truest indicator of real demand.
So if the demand is real, the obvious question is, what's making millions of consumers suddenly reach for more Coke in the middle of 2026? I mean, it's not a new tech gadget. What's the catalyst?
It really comes down to how the company intersects with culture. And the Q2 report points to one massive singular catalyst, which is the 2026 FIFA World Cup.
It's honestly wild to think that a single soccer tournament has enough gravitational pull to move the needle on a $13 billion quarter.
I know, but the numbers are right there in the release. The World Cup campaign directly contributed to a big chunk of that 5% volume growth for trademark Coca-Cola. And it drove a massive 8% surge in volume for Powerade.
That is huge.
Yeah.
So how does that actually work mechanically? Just slapping a logo on a stadium doesn't instantly make someone thirsty.
Right. The industry calls it drinking occasions. Sponsoring the World Cup isn't just about brand awareness or billboard space. It's about linking a massive human behavior like millions of people gathering in living rooms and bars to watch a match to the physical act of opening a beverage.
Okay, so they essentially manufactured millions of new drinking occasions simultaneously around the world.
Exactly. By positioning their brands at the center of that global moment, they created an immediate spike in consumption.
That explains the global volume spike for sure. But there is another strategy in the report that seems totally opposite to a monolithic global event like the World Cup. They talk a lot about consumer-led innovation driven by local innovation hubs.
Yeah, and this is arguably their most crucial shift in long-term strategy. Historically, multinational beverage companies were super centralized.
Like a giant lab in Atlanta trying to invent one drink for the entire planet.
Right, which is just impossible today given how fragmented consumer tastes are. A flavor profile that crushes it in the American South might totally bomb in Asia.
So they just decentralized the whole R&D process.
Exactly. They now operate these regional innovation hubs. If a local team spots a micro trend, say a specific spicy sweet flavor taking off in a few neighborhoods in Mexico City, they develop a product just for that local market, and they do it fast.
And I guess if it bombs, it's just a tiny, contained failure that doesn't cost the global company billions.
Yep. But if it succeeds, they use a strategy they explicitly call lift and shift. They take the data, the marketing blueprint, the formula, and they rapidly scale it across other global markets with similar demographics.
That is incredibly smart. It's decentralized testing mixed with global scaling.
Much faster and way less capital intensive than guessing from a boardroom.
Okay, so they sold millions more Cokes during the World Cup, and they have these local innovations spinning up. But earlier, the report noted that input costs are higher, right? Like raw materials, fuel, all of that.
Oh yeah, inflation is still very much a factor on the cost side.
Plus, sponsoring the World Cup costs an absolute fortune. So mathematically, if your expenses are going up on both ends, shouldn't your margins shrink? Did paying for all that marketing and sugar wipe out the extra sales?
Well, the Q2 margin analysis gives a definitive no on that. Their operating margin actually increased to 34.9%, up from 34.1 last year.
Wait, really?
Yeah, and if you look at comparable operating margin, which, excludes one-time items, it hit an impressive 35.6%.
Okay, you have to break that math down for me. If they're spending significantly more on marketing and raw materials, how are profits actually widening?
It comes down to operating leverage. Because Coca-Cola already has the factories built and the distribution network running, the fixed costs are mostly covered.
Right, like a giant funnel.
Yeah.
Once the hole at the bottom is full, paying for rent and corporate salaries, any extra revenue you pour in?
Just spills right over the edges into pure profit.
Exactly. So generating a 5% increase in volume doesn't require building 5% more factories or hiring more accountants.
So the revenue from those marginal World Cup sales drops almost entirely to the bottom line, totally overpowering the higher input costs.
That is operating leverage in action. The underlying gross margin expanded by roughly 40 basis points, and underlying operating margin grew by roughly 20 basis points.
And just for context for you listening, a basis point is 1/100%, so 40 basis points is 0.4%, which on $13.4 billion in revenue is tens of millions of dollars in pure profit. It matters immensely. Though, to be totally accurate to the financials, the gap margins were also smoothed out by some external factors. The report notes currency tailwinds, so exchange rates helped when converting international sales back to U.S. dollars.
I also saw a note about a structural move in Africa impacting the margins. They divested their finished product operations in Nigeria, right?
Yeah. Finished product operations typically carry lower profit margins than just selling the concentrate. So by offloading that lower margin operation, their overall consolidated margin mathematically ticks up.
But even stripping all that away, the underlying business outran the rising costs. Let's actually look at how this played out regionally, because the geographic segments reveal a lot about the global economy right now.
They really do. You absolutely cannot manage Latin America the same way you manage North America.
Let's start with Latin America then, because they absolutely dominated this quarter. Volume grew 5%, net revenues exploded by 16%, and operating income jumped a massive 23%.
It's the textbook example of pricing power in an emerging market. They strategically raised prices and optimized their product mix so well that consumers just absorbed it. They didn't trade down to cheaper generic alternatives.
Which shows incredible brand loyalty. But then you contrast that with North America, a much more mature market. Volume growth was only 1%. But they still posted strong price mix growth of 4%.
Right, and what stands out there isn't soda. The report specifically highlights value-added dairy and juice, naming Fairlife and Core Power.
Which ties back to drinking occasions again, right? Consumers here are leaning heavily into health and protein-forward nutrition.
Exactly. They pivot the occasion to a post-workout recovery drink or a high-protein morning commute. Scaling those premium brands captures higher margin sales and makes up for flatter soda volume.
But then we get to Asia Pacific, which is fascinating. Volume there grew by a massive 8%, largely driven by India.
Yeah, huge volume growth.
But the report clearly states they actually lost overall value share in the region. How do you sell 8% more physical product but lose market share?
It's the ultimate paradox of emerging markets. It highlights the difference between volume share and value share. Volume share is the physical number of bottles. Value share is your slice of the total financial revenue generated by the whole industry in that region.
Okay, so if the Indian beverage market is expanding rapidly.
You're right. Millions of new consumers are entering the middle class. Coca-Cola sells 8% more volume, so their absolute revenue goes up.
But if local competitors are flooding the market with cheaper alternatives and growing their volumes by, say, 20%.
Then the total financial value of the entire market grows faster than Coca-Cola's specific slice. They're making more money, but their percentage of the total cash temporarily shrinks.
Well, that shows how fiercely competitive Asia Pacific is right now. Which brings us to the final piece. Looking ahead. Management officially raised their full-year guidance for 2026.
They bumped it up across the board. Organic revenue is now expected to grow approximately 5%, and comparable EPS growth is up to a range of 9 to 10%.
When CEO Henrik Braun mentioned the dynamic consumer landscape in the report, he was acknowledging a really volatile global economy. But raising guidance means they're incredibly confident their pricing power and marketing will hold strong.
And the financials back that up, especially the cash flow projections. They project about $14.6 billion in cash from operations this year.
Minus the estimated $2.2 billion in capital expenditures for factories and trucks, leaving a massive $12.4 billion in free cash flow. That is a staggering war chest.
Free cash flow is the absolute lifeblood of a company like this. It gives them the strategic flexibility to fund those local R&D hubs, acquire emerging brands, or just weather unexpected supply chain shocks.
It keeps a 138-year-old giant as agile as a startup. So to wrap this up for you, volume is up, revenue's up, margins expanded thanks to operating leverage, and guidance is raised.
All fueled by a mix of massive global events and hyper-local innovation.
Which leaves me with one final thought for you to ponder. Coca-Cola's success this quarter leaned heavily on that lift and shift of local innovations. As the world gets more interconnected, are the days of the monolithic, one-size-fits-all American beverage over?
It definitely suggests future global brands will be defined by adapting to thousands of micro markets, not just one flagship product.
If the next billion-dollar brand is born in a local lab in Asia rather than Atlanta, it completely changes the identity of the ultimate American legacy company. Definitely something to think about next time you're in the beverage aisle. Be sure to follow the show for our daily earnings coverage, and we'll see you next time.